Short selling, or shorting a stock, is a strategy that allows you to make money on stocks that fall in value. To understand shorting, we need to use an example. So imagine your friend John has a bunch of comic books. He has one comic book that's selling for around $500 online. After doing research, you think that this price is really overvalued, and you don't think it's worth $500. So you ask John if you can borrow his comic book. John says sure. So you borrow his book and immediately sell it on eBay for $500. Now you might be thinking, wait, isn't that stealing? Well, not quite. See, when John asks for his comic back, you can just rebuy it and give it back to him. So let's say the comic book fell from $500 to $450. You can buy the comic book for $450 off eBay and then give it back to him, and then you keep that $50 profit. This simplified example is similar to how shorting works. Let's say Apple is trading at 130. If you short one share, you'll make money as it drops. If it drops to 120, to close this trade and get out, you'd basically buy Apple at 120, and this share of Apple that you're buying will automatically be given back to the broker from which you borrowed it from. Now, since you previously sold it for 130 and you bought it back for 120 and returned it, you keep the $10 difference. The issue with shorting is that there's theoretically unlimited risk. So let's say instead of shorting that you decide to buy a single stock of XYZ at 100. You know, worst case scenario, if the company goes bankrupt, the most you can lose is $100 per share. But in this comic book example, your risk is undefined. What if you borrow that comic book and sold it for 500 and then it rises to 700 overnight, or something really bizarre happens and it rises to 1,000? Now, to get out of this deal, you need to buy the comic book back at 1,000 and then return it to John. Ouch. So because of the theoretically infinite risk of shorting, there's strict margin requirements. The Federal Reserve initially requires 150% margin for any type of short. So let's just say that XYZ is trading at 100 and you decide to short it. You need to have 150% margin, or at least $150 per share, put aside when shorting. In addition, there's maintenance margin, which basically helps to protect the broker in case the trade starts working against you. So let's go ahead and use XYZ again. Let's say that you shorted 100 XYZ when it was trading around $100. As you know, the initial requirement is 150% to open the short. So that 15,000 is just a requirement to open the short. Now, as the days go on, there's maintenance required to make sure that if the trade moves in a non-beneficial way, the broker is covered. So let's say that XYZ moved from 100 to 105. We're losing money because now when we return the shares, we have to buy them back at 105 and then return them. So we're losing $5 per share. Different brokers have different maintenance requirements, but let's just say that your broker has a 40% maintenance requirement. So first up, take the value of the shares. So we have a $105 stock times 100 shares. So we get 10,500. Then take that value and times it by the maintenance requirement. So 10,500 times 40% is 4,200. If we add those together, we get 14,700. So remember, our initial margin requirement to open this short covered us for $15,000. Since we're under $15,000, we're okay. We can continue to hold this trade. Things are okay for now. But let's just say that XYZ rises to $110. So now the value of the stock is $11,000, right? Because 110, of course, times 100 is 11,000. And then $11,000 times the 40% maintenance requirement is 4,400. 11,000 plus 4,400 is 15,400. Remember, we're covered up to $15,000 for that initial short that we opened. So now we're $400 over. Since we're $400 over, this would result in you getting a margin call. A margin call is basically the broker telling you, if you don't deposit $400, we're gonna close this trade for you. Obviously, the higher the margin call amount, the higher the risk you're presenting to the broker. And if you don't cover it within 2 to 5 days, they're gonna close it for you. In addition to that, within your broker, there's also some stock that are considered hard to borrow. These stocks are on very low supply to borrow, and thus to borrow them from your broker, you have to pay a daily fee. Now, this fee is basically a daily fee for holding. So this really only becomes a problem if you're gonna be holding these overnight for a couple days and things like that. So this is really only a consideration if you're gonna be swing trading and holding overnight. So let's take, for example, stock ZZZ. Let's say ZZZ was trading at $10 and you shorted 100 stock. $10 stock times 100, of course, is 1,000. So total value for this trade is 1,000. But let's just say ZZZ is being heavily shorted and thus it's become HTB, or hard to borrow, with a 6% borrow rate. There's a little bit more of an in-depth formula for this, but the easiest way to calculate this is to take the total value and multiply it by the HTB rate. So $1,000 times 6% is $60. Then divide that 60 by 360. not 365, because interest is calculated assuming each month has 30 days and 12 months. 12 months times 30 is 360, and 60 divided by 360 amounts to around 16 cents a day. Obviously, the more stock you short, the higher this fee will be. So shorting is definitely riskier due to the theoretically infinite risk. So for example, if you shorted 100 GameStop on January 26, when it closed at 147, you would have woken up to GameStop being over 300, meaning you'd be down $153 per share. Of course, shorting 100 means times 100, so you'd be down 15,300, and your broker would basically be margin calling you out the wazoo. So if this undefined risk sounds a little bit scary to you, I'd actually recommend trading options via puts or bear call spreads if you're bearish. In case you don't know how to do that or you're new to options, I've made an A to Z guide on options with strategies over on rocketoptionu.com. So be sure to give that a look. I have the details in the description. But if you do decide to short the stock, I always advise short-term plays for beginner traders. While any stock can have a large run overnight and screw you if you're holding shorts, I feel that low float stocks and penny stocks are the ones that can really mess you up. So if you're testing a strategy out, please try this with larger stocks, blue chips, and ones that are less volatile. All right, so you know from my previous videos in terms of trading, I'm using the moving average with the 9, 20, and 180. I'm using the RSI, and I'm using the MACD. In case you're new to my channel and don't know what these are, I have separate videos on all of these, so make sure to check my previous videos. Now, one thing about stocks is that they take the stairs going up, but they jump out the window going down. So the moving average isn't really fast enough to grab some of these movements, so we're actually going to change the moving average study. So we'll go over to our indicators. So go to indicators here, go to edit indicators, and we're going to go to, instead of MA, we're going to do EMA. So click EMA and take off MA. For EMA, again, we're going to do the 9, the 20, and the 180. Go over to style, turn these on. Again, I like to keep my 9-day like a cyan color, my 20 a yellow, and my 180 a red, and then we'll hit done. So now we have the EMA instead of the MA. So on the top left, there's a pencil icon, so click that for drawings and go to horizontal line here. Click the top of the candle, then go back again and click horizontal line and click the lowest candle and the lowest part of the wick really. So now we have support and resistance lines. Just as a quick refresher, a resistance line is basically the point where the stock is having trouble breaking above, and the support is the point where the stock won't really go below that area. So with resistance, what we're doing is basically when it bounces off of the resistance line, that's an opportunity to short. The stock wasn't able to break above the resistance, and because of that, they're sort of bouncing back a little bit. So if you bought a short around here, that would have been a good opportunity for you to kind of run this down. And then when it went back above the 9-day EMA here, you could have closed your short here. But again, there's times where it'll actually break above resistance, and that's when the stock kind of reaches all-time highs. And you can see it kind of broke above this and hit 145.09, and then it quickly went under. So this type of play was a little bit dangerous if you would have bought a short here, because you can see the wicks were very long here. There's a lot of battling between the buyers and sellers. So I don't really advise doing it if it breaks above the resistance, because it can be kind of difficult to play that. But what ended up happening was that it kind of fell off, consolidated a little bit, and tried to break above on this candle again. But again, it got rejected. It wasn't able to break above the previous resistance here. So because of that, the stock actually fell down pretty rapidly. So the correct way to play this basically was that when it went under the EMA here, which was around this candle here, you could have bought your short there, and then you can see it pretty much just fell off there. And then the point where the candle opens above the 9-day is the point where you want to get out. So it looks like around here, you would have been getting out of this trade. If we follow it along, here's another example of a candle that it almost touched the resistance line, but not quite. And then from there, it kind of got rejected and then fell underneath again. And I'd actually create a new support line here because this support line is way too low at this point. So I'd actually use this candle here to create a new support line moving forward. And then since this was sort of the new high here, we'll actually create the new resistance line here and kind of keep it a little bit more tight. So moving forward for Apple, what I'm looking for is this candle starting to come up again. It's looking like it's going to recover, but will it be able to break past the resistance line here, or will it bounce off again? If it does bounce off again, that's a good opportunity to get into a short and then watch it fall down. And then again, when the candle, after it bounces off, when it shows that it's going back above the 9-day EMA, that's the point where you want to close it and buy it back, so that way you're able to close the trade profitably. Another area that helps is your RSI. If the RSI is above 50, that means that it's closer to overvalued. So stocks that are more overvalued have a higher chance of pulling back, as well as, look at this right here, the MACD. The MACD was a perfect indicator right here. You can see that it's having a negative crossover here. So if you bought a short here, you would have been looking pretty good. To actually place this short, what you're gonna wanna do is on the right-hand side, there is something called short. So just click that and you can either make it a limit, market, or stop, and then you can short as many as you need. Shorting is only allowed on margin accounts, so make sure that you have a margin account. And I believe you need over $2,000 in the account to be able to short or to be able to use a margin account properly. I hope this video gives you a good intro into shorting and the risks and benefits involved. If you found the contents of this video to be helpful, make sure to like and subscribe. It really does help my channel to grow. And I'll be providing more content weekly on stocks and trading. Thanks so much for watching, everyone. And as always, keep on making great trades.